of March and will close on 21st of March. We've tried to make this product attractive, and there will be a discount offered to all investors of the NFO, with the retail investors getting an additional loyalty bonus or loyalty units if they hold the NFO units for a period of 1 year. I'll request my colleague Vijesh to walk you all through the product and about ETFs. Vijesh is based out of Bangalore and looks after the southern region as well as covers institutions for Goldman Sachs.
Yeah, impressed. Before I give you a brief of what the CPF and the launch is about, let me give you a very small introduction of what ETFs are, because some of you may not know what ETFs are. So I'll just give a brief about what ETFs are. Today when people invest into stock markets, there are two ways of investing. One, they can go and buy stocks. They can go choose stocks and they can buy through a broker. The other way of investing is people go and buy a mutual fund. Now a mutual fund, when you buy a mutual fund, the benefit is that you get a portfolio of stocks. There will be at least 20-30 stocks in a mutual fund, so people go and buy a mutual fund. So ETFs typically are a hybrid product which takes the advantage both of a mutual fund and that of a stock. So when you buy an ETF, you buy an ETF just like a stock, but you get a basket of securities, like a mutual fund. So when you buy an ETF, instead of getting one stock, you get about 10, 15 or 20, 30 stocks, and it typically replicates some kind of an index. So in my presentation, I'll just take you through a brief about ETFs, what are the developments that have happened in the ETFs worldwide and in India, advantages of ETF, and finally about the CPSE ETF that we're going to launch next week. ETFs can be of various types, typically equities, they are also of commodities. We have another ETF that which is a very famous ETF, is called Gold ETF, and also money market ETFs or liquid ETFs. Internationally, the growth of ETFs has been very phenomenal, okay, but not to the extent that has happened worldwide because it's fairly new product in India. There are about 39 ETFs today having an AUM of about 10,500 crores. As I told you earlier, ETFs give people the advantage both of a mutual fund and that of a stock. When I say a mutual fund, people can buy ETFs one shot, like when you buy one unit of an ETF, you typically buy into many companies and so you get instant diversification. And ETFs are also traded like a stock. So intraday, people can buy and sell ETFs at any point in time, right? They are more transparent because people exactly know what they are buying. Because typically ETFs replicate an index and the index is already known to all the people who buy the ETF. So let me go to the CPSE ETF that we're going to launch next week. The CPSE Index. The CPSE Index was constructed to facilitate the divestment program of the government. To calculate the percentage of each stock in the index is same as that of a Nifty index. I'm sure that you are aware of a Nifty index. It uses a market capitalization methodology to calculate what should be the percentage of each particular stock. Third, the companies that are going to be part of the ETF should have a market capitalization of more than 1,000 crores. And the fourth criteria is all the companies that are going to be the part of the ETF should have given at least a dividend yield of 4% per year for the last 7 years ending June 2013. So based on this criteria, the Department of Divestment has decided to select 10 stocks that will be part of the divestment ETF, and these stocks will be allocated in the percentage based on the market capitalization. These are the stocks that will be part of the ETF, starting from ONGC, which will be the largest, GAIL, Coal India, Rural Electrification Corporation, Oil India,
the ETF itself and enable the entire disinvest program to be done through a fund structure. Now, the government of India had invited bids for the asset manager about a year ago, and we were successful. One thing I want to add, which we just mentioned, the expense ratio of this scheme would be 49 basis points, and Goldman Sachs will be responsible for ensuring that the ETF is will be the asset manager responsible for the ETF. So how it will work is the government cannot issue a basket of securities directly to the investor and ensure it's traded. So the government will transfer the shares to Goldman Sachs, and Goldman Sachs then will issue units to the investor. So the investor can then list on the exchange. So the investor can enter or exit on the stock exchange. And this is in addition to the government's disinvest program. So it will continue with its FPOs as well as the offer for sale. This is another mechanism which will help the company.
So for the price that you're paying, what is the earnings? A lower P ratio means the earnings is more than the price that you're paying. So higher earning companies may have higher dividend.
What is government giving 5% discount?
See, 5% is typically to attract people